Hi, and welcome to our weekly look at the main stories that have impacted the market so far. And unfortunately, it looks like we're going to start with the Great British Pound yet again. I seem to be talking about this an awful lot. Pound hit a 20-year low this week. On Monday, we saw Liz Truss appointed as the new UK Prime Minister, after a rather laborious and some would say one-sided horse race. Mixed reception amongst business community and the electorate. But Liz Truss does come amidst a background of an unenviable milestone of an already flagging British economy and sterling being at its lowest point in 20 years. There was a small turn Monday after the news came out. However, we are now looking at around the 114.7 to 114.8 mark for sterling against the US dollar. Now, there's the outlook of the potential 20% inflation rate by January 2023. Continued strong language being used by the incoming, or in fact the new Prime Minister, with regards to Russia versus the Ukraine situation that's going on. And of course, a plundered public purse with lockdowns and stimulus and money being spent left, right and centre. The global FX market does seem to have become a little bit used to this escalating inflation, because if it hadn't, all of the currencies would be affected, not just sterling. And if you compare sterling's performance to the dollar and the euro, they're faring an awful lot better. So it's fair to say uncertainty looms for the Great British Pound yet again. Okay, the second thing we're going to have a look at, and we're going to stick in the FX markets, is a new extreme for the Japanese yen. Earlier this week, the yen was already down 2.5% on the week alone. And in fact, it's down 20% since the start of 2022. We saw it break the psychological level of 140 yen per dollar earlier this week. Now, this is a little bit of concern in terms of psychological levels, obviously, and its overall performance. And the Bank of Japan is likely to maintain a massive stimulus package to offset the slowdown in global growth. The Bank of Japan board member, Kataoka, told Reuters earlier this week. Now, this was backed up by Finance Minister Suzuki, who said that the yen's movements have been rapid and pretty much one-sided. Then we have the Chief Cabinet Secretary, Matsuno, say the government would like to take necessary steps if this swing in the Japanese yen continues. There's clearly some concern about stability of the yen in Japan. Now, given statements like this, I think it's fair to say we can assume that volatility will continue for the Japanese yen in the coming weeks. And it is possible we may see a reversal from the upper line of the rising channel as large players take the profits they've seen with what's happened so far this year, the backdrop of potential intervention from the Bank of Japan. Certainly one to keep your eyes on in the coming weeks. So a little change of tack now. We're going to take a look at stock price news. Has Apple's presentation affected its share price? Now, we had the big reveal, as a lot of people like to refer to it, in with new watches, the iPhone 14, etc., the sort of annual big bang, if you like, for Apple itself. Now, we often see a jump in the share price with innovation of new products, but there was only a small marginal rise in its share price this time round after their presentations. Perhaps these innovations were expected, or is there other factors at play? Apple shares have actually performed stronger than the S&P 500 index in the last 2 to 3 months. However, if you look at the charts, it is starting to fit into a downward channel. And in fact, Apple could cost us less than $150 a share if it declines to the median of that channel line. Now, interesting, Apple outperforming the S&P, but even market leaders struggle to grow if the overall market is bearish itself. Is that what's happening to Apple here? Or is it just a little bit of, malcontent or a little bit of disappointment with the new product line? As ever, Apple is a main playing stock. As ever, worth keeping your eyes open. Okay, finally, we're going to take a look at international impacts. And what we're going to look at is China's lockdowns and how they're affecting oil and the FTSE, and in fact, potentially dragging those prices lower. There are some trade figures out from the Chinese government which have affected the price of raw materials. China's massive output and its placement as the world's manufacturing centre feeds its own domestic market, of course, and it makes it the highest importer of crude oil in the world. Now, the figures that came out earlier this week showed export growth year on year of 7.1% and import growth of 0.3%. Sound like good figures, but they were actually way below expectations. A lot of the blame for that is being placed on the continuing extreme lockdowns that we're seeing in China, with whole cities being locked down, people not being allowed out. That's clearly going to have some sort of impact on production levels. Now, China only really imports raw materials. Thus, the slowdown that we're seeing in its growth has a knock-on effect in demand for oil and raw materials. Now, Brent crude was below $92 a barrel shortly after these figures came out. And this weighed heavily on energy and mining stocks, which are pretty major constituencies of the FTSE 100. And we saw a fall in the FTSE 100 off the back of this. It wasn't catastrophic, but I think it does highlight the impact on the FTSE of figures across the globe. With such an exposed global players, we have to take into account not just what happens in the UK, but further afield as well.